Hi, welcome to FxScouts Trader Education. In this video, we're going to cover one of the most important technical indicators, the 200-day moving average. So what is the 200-day moving average? The 200-day moving average is a technical indicator used to analyze and identify long-term trends. Essentially, it is a line that represents the average closing price for the last 200 days, and it can be applied to any financial instruments. The 200-day moving average is widely used by forex traders because it is seen as a good indicator of the long-term trend in the forex market. If the price consistently moves above the 200-day moving average, then this can be viewed as an uptrending market. Markets consistently trading below the 200-day moving average are seen to be in a downtrend. So how do you calculate the 200-day moving average? Like other moving averages, the 200-day moving average can be calculated by adding up the closing prices for each of the last 200 days and then dividing this by 200. Each new day creates a new data point. Connecting all the data points for each day will result in a continuous line which can be observed on the charts. How do you use the 200-day moving average in your trading strategy? The first way to use the 200-day moving average is as a trend identifier. And one of the easiest strategies to incorporate the 200-day moving average is to view the market in relation to the 200-day moving average line. Traders commonly do this to analyze the general market trend and then look to only place trades in the direction of the long-term trend. As is commonly said, the trend is your friend, and in order to reduce your risk, it is important to place trades in the direction of the trend. As you can see on this chart, the market is trading above the 200-day moving average for a prolonged period of time. This means that the market is trending upwards, so traders should only be looking for long entries into the market. This example makes use of the stochastic oscillator as well, and traders should make use of an indicator or any other criteria they feel comfortable with in order to ensure that they make the right decision for their entries and for their exits. The second strategy is moving average crossovers. So once the long-term trend is identified, traders often assess the strength of the trend. And this is important because a weakening trend could signal a trend reversal and presents the ideal time to exit an existing trade. So incorporating shorter term moving averages like the 21, 55, and 100-day moving averages allows traders to determine whether the existing trend is running out of steam because they track more recent price movements over a shorter period of time. In the chart below, you can see how the smaller, faster moving averages signal that the uptrend may be about to reverse. The 21-day moving average crosses through the 55-day moving average and continues to cross the 100-day moving average, and that then crosses the 200-day moving average to the downside. These are all bearish signals that present before the 200-day moving average shows the bearish signal. And the third way that traders often use the 200-day moving average is as a support and resistance level. It can be used to identify key levels in the forex market that have been respected before, and often in the forex market, the price will approach and bounce off the 200-day moving average and then continue in the direction of the existing trend. So the 200-day moving average can be viewed as a dynamic support or resistance. And as you can see on the chart, this is an example of how price approached and bounced off the 200-day moving average. Traders will look to go long as the price bounces off the 200-day moving average when the market is in an uptrend. And likewise, traders will look for short entries after price bounces from the 200-day moving average in a downtrending market. Stops can also be placed below the 200-day moving average in an uptrend or above the 200-day moving average in a downtrend. In summary, the 200-day moving average is a widely adopted indicator showing the direction of the long-term trend in a market. It can be used as dynamic support and resistance and acts as a good indicator of where to set stop orders. Then, because of its mass adoption and because so many traders use the 200-day moving average, they can be considered a self-fulfilling prophecy. And lastly, traders use the 200-day moving average to filter trades in the direction of the long-term trend and look for bounces off the moving average to inform their trades. Thanks for watching. If you have any questions regarding the 200-day moving average or any other trading related questions, please don't hesitate to get hold of us. Our website is FxScouts.com. And if you have any questions or comments, please place them in the comment section below.